Anyway, up next, Andrew Kanaly, chairman of the appropriately named Kanaly Trust Company, with his 5 key drivers of this market and ways to capitalize on each. Our next guest, keeping financials on the bench instead of betting on private equity, energy, and oil services. Joining us from Houston this morning, Drew Kanaly. He is chairman of Kanaly Trust, where he has about $2 billion in assets under management. Drew, good morning. Thanks for being with us.
Good morning, Mark. Good to be here.
Okay, so what are you doing in this market environment?
Well, we're taking a look, Mark. Now, let's all calm down and look at what is in good shape. We still have tax policy in good shape. We still have trade policy in good shape. Regulatory policies in good shape. And really, Fed policy is just fine, too. What we're going through is a little credit market turmoil. And what the Fed has said is this is a market-created event. The market's going to create it, and we'll be at the discount window for you if you need us.
So you agree, or you think, that the Fed has done enough and needn't lower the discount, the Fed funds rate?
Well, it's not a matter of if they need to. It's a function of they probably have to at this point. If you look at the 91-day T-bill rate, you know, Fed funds almost always follow this rate historically. This is one of the longest periods where T-bills have been below the Fed funds, and now the gap between the two is one of the largest ever. So at some point the Fed's going to have to act. What Chairman Bernanke has told us is he's looking at energy prices and he's looking at unemployment rates. And I think today we had jobless claims come out. They were higher. We had jobless claims revision from the past report that were revised higher. So we're moving much closer to a Fed rate cut.
Drew, I'm still curious when you know, and I know Hank Paulson was saying this the other day, it's a market-created event. He's been through turbulence and storms like this before. It sounds similar to what you're saying, but then there is this other issue, which is that you had all sorts of companies, marginal companies, getting loans at rates that they wouldn't have been able to get loans in a different environment, but they have them. Now we're worried about whether they're going to be able to pay them off. And the same story is true for many American home buyers. If that is true, it is hard to imagine how this is just a market-created event. It doesn't matter who created it. It's an economic event.
It's maybe $500 billion in loans we're talking about. We're not talking about a 100% default rate. And we still have the possibility that some of those loans don't get reset as high as they could be. So I assure you all of these credit holders are looking at it saying, what's the best way out of this box without total default?
So, right, so it's in their interest, obviously, to try to work with the borrower, whomever that may be. Marginal company, marginal home buyer, nobody wants a default foreclosure.
Absolutely. And then what you're seeing in the financial markets is when they try to sell these loans in the packages, they're getting basically sort of a no bid. So it's like you're trying to sell your house in a soft market and no one's made a bid. It doesn't mean your house is worth zero. It just means today, no bid.
All right. So, okay, go ahead. Mark had something there.
Okay, we'll get away from that housing analogy. I mean, a property's worth what a willing seller and a willing buyer can agree on, and if they can't agree on a price, then it is, there's no value, determined at least. But I'd like to move on to commodities anyway, because I'm reading the notes that you provided, or somebody provided on a discussion with you. You think that we've seen a shift in the commodity market? Is it a long-term shift away from the ever-rising prices based on expected demand from Asia?
Right, what you've had is a demand shift. If you look from about 2003 forward, whether it's oil or any basket of commodities, you've just seen a big demand shift. And over that period of time, we've not seen the inflation that was always expected. And now we're starting to see those commodity prices start to trade in a band, and the Fed's inflation fears should be diminishing at this point.
I see. So it's a lesson for the Fed.
Well, for all of us. I mean, it's just because commodity prices go up does not mean you always have inflation following.
Now, you are currently underweight financials, right? You're not...
Well, I mean, it's a market to an underweight. And what it kind of looks like when you really look at it historically now is, you know, way back when in the 80s you had consumer non-durables. They became the largest portion of the S&P 500, then oil, service, and energy, and then tech. And so what you kind of, if you look at the S&P 500, you sort of had financials sort of take over, and it looks like it's sort of consolidation time for financials.
All right, Drew, thanks a lot. Appreciate it.
Okay.
Thanks, Drew.
Kanaly. Join us from Houston.